As of December 2019, this regular podcast is available on our Andy Yeh Alpha fintech network platform. Global debt surges to more than $250 trillion in the fiscal year 2019. The International Institute of Finance Analytic report shows that both China and the US account for more than 60% of this sharp increase in global debt. In particular, global government debt increases from $65 trillion to $70 trillion in the fiscal year 2019, and this increase arises primarily from the recent surge in U.S. federal debt. This latter public debt accumulation results from the recent Trump tax cuts and infrastructure expenditures. Meanwhile, the current low interest rate environment makes it extremely easy for public corporations and sovereign wealth funds to borrow more money worldwide. Total government debt represents more than 2.5 times annual real GDP in China. Low long-term government bond yields and high corporate debt mountains continue to be red alerts for the next recession in several economies such as Britain, France, Germany, Japan, Italy, and Spain. The monetary authority cannot sustainably fund fiscal deficits via new public bond issuance without an eventual increase in money supply growth or price inflation. When push comes to shove, an inflationary shock above the 2% target may tilt the central bank response toward a hawkish monetary policy emphasis on price stabilization. Former White House Chief Economic Advisor Nouriel Roubani discusses the main limits of central bank-driven fiscal deficits. The International Monetary Fund, IMF, projects lower global economic growth due to the recent trifecta of the tentative Sino-American trade agreement, geopolitical energy tension in the Middle East, and a cloudy economic outlook for Britain and Europe in light of soft Brexit trade uncertainty. These global tail risks help anchor inflation expectations worldwide, so many central banks engage in active monetary policy coordination in accordance with the tripartite congressional mandate of maximum sustainable employment, price stability, and financial market stabilization. With greater government bond issuance, central banks can help fund fiscal deficits that manifest in the form of both tax cuts and infrastructure expenditures. Left-wing proponents of modern monetary theory argue that larger permanent fiscal deficits can help stimulate economic growth when central banks monetize these fiscal deficits in the absence of runaway inflation and economic slack. However, Roubani contends that the current monetization of fiscal deficits cannot be a sustainable policy response in the long run. Either the global economy experiences a supply shock due to pervasive shortages of oil and natural gas, or an inflationary shock becomes a major economic disturbance worldwide. European Commission President Ursula von der Leyen seeks to protect the circular economy and green growth from 2020 to 2050. The circular economy represents a major European effort to achieve net zero carbon emissions by 2050. This effort continues to be the top priority of the new European Green Deal. From December 2015 to present, the first Circular Economy Action Plan serves as one of the hallmarks of the European Union. One of the key highlights is a universal ban on single-use plastic products such as cutlery and food containers. The European Union plans to recycle 70% of all packages by 2030 under the European Green Deal. Circularity can bridge at least half of the climate change gap toward the 1.5 degrees Celsius target for maximum sustainable economic growth and employment. The new circular solution can help reduce hundreds of millions of tons of CO2 emissions. The EU Council of Ministers now demands more sustainable policy measures to encourage the reuse of both batteries and plastics across different industries such as food, transport, and construction. As European Commission President Ursula von der Leyen advocates, eco-design technology not only helps improve energy efficiency with lower CO2 emissions worldwide, but also contributes to better social harmony and economic growth. J.P. Morgan Chase CEO Jamie Dimon views wealth inequality as a serious economic problem in America. Dimon indicates that the rich Americans have been getting wealthier too much in many ways. In contrast, Dimon further observes that middle-class income remains flat for maybe 15 years or so. This economic divergence cannot be particularly good in America. Some demographic changes may be the root cause of both wealth inequality and a rare lack of trade-off between inflation and unemployment in America. The latter has profound public policy implications for the Federal Reserve and Treasury in terms of dovish interest rate adjustments with better fiscal prudence. The Sargent-Wallace monetarist arithmetic analysis suggests that the monetary authority cannot contain inflation with maximum sustainable employment and price stability when the government continues to issue new public bonds to fund incessant fiscal deficits on top of national debt mountains. The Dimon remarks emerge amid many criticisms of the top 1% U.S. income cohort by Democratic Senator Elizabeth Warren, former Vice President Joe Biden, and former New York City Mayor Michael Bloomberg. Dimon further suggests that both income and wealth inequality may inadvertently widen disparities in economic opportunities from education and healthcare to employment and technology. America and China cannot decouple decades of collaboration in trade, finance, and technology. In recent times, some economists claim that China may decouple decades of trade collaboration with the U.S. on the primary basis of better tech supremacy on the Eastern Front. Also, several other economists claim that China may revamp financial services and technological innovations ahead of America. Goldman Sachs Chief Strategy Officer Stephanie Cohen indicates that these claims are overdone. Specifically, Goldman Sachs continues to pursue new business opportunities in China after about 2 decades of investment bank penetration there. In recent years, Goldman Sachs invests $60 million to bail out depositors in Chinese brokerage firm Hainan Securities, which offers rich political connections in the one-party regime. Moreover, Goldman Sachs receives official approval from the China Securities Regulatory Commission, CSRC, to boost its equity stakes in Goldman Sachs Gaohua Securities to the maximum cap of 51% from 33%. With managerial control over the joint venture, Goldman Sachs retains a key competitive advantage over its rivals such as JP Morgan Chase, UBS, and Nomura etc. This competitive edge empowers Goldman Sachs to further invest in Sino-American trade, finance, and technology in light of the new bilateral fair trade agreement. China turns on its new 5G telecom networks in the hot pursuit of global tech supremacy. China Telecom, China Unicom, and China Mobile reveal 5G fees of $18 to $20 per month. These state carriers offer 5G network services up to $100 per month for 300 gigabytes of fast data transfer with 3,000 minutes of phone calls. Meanwhile, Chinese telecom carriers expect to begin the 5G rollout by mid-2020. Some experts warn of challenges to 5G network proliferation because there are now few 5G-capable mobile devices. 5G commercial network services are now available in 50 major cities in China, e.g. Beijing, Shanghai, Guangzhou, and Shenzhen. By 2025, China is likely to become the biggest 5G market in the world. The country can account for the largest number of 5G connections worldwide. Specifically, China can reach 110 million 5G users in 2020. As the British mobile industry body GSMA suggests, this massive scale may dwarf the combination of North American and European 5G markets. 5G is one of the key battlefields where China and the US engage in an active tech race. The recent Sino-American trade conflict resolution can help better align the economic interests of both superpowers in the 5G network domain. Saudi Aramco aims to initiate its fresh IPO in December 2019. Several investment banks indicate to the Saudi government that most investors may value the Middle East oil company at the target range of $1.5 trillion to $1.7 trillion. This current stock market valuation falls short of the $2 trillion benchmark that the Crown Prince Mohammed bin Salman anticipated to see during his first Saudi Aramco IPO announcement back in 2016. As the most profitable state oil enterprise, Saudi Aramco is worth almost twice the equity valuation of Apple, which leads almost all U.S. public corporations in terms of stock market capitalization. Also, Saudi Aramco earns more than the overall net income of the other top international oil companies, ExxonMobil, Royal Dutch Shell, BP, and Chevron. The prince expects to funnel the Saudi Aramco IPO proceeds into a new sovereign wealth fund that helps the Middle East kingdom wean the fragile Saudi economy off its long-term reliance on oil production. The sovereign wealth fund can empower Saudi Arabia to diversify across numerous new industries such as internet search, mobile pay, artificial intelligence, robotic automation, cloud computation, and semiconductor technology, etc. This diversification helps minimize the main national security threat to Saudi Arabia. Federal Reserve institutes the third interest rate cut with a rare pause signal. The Federal Open Market Committee, FOMC, reduces the benchmark interest rate by 25 basis points to a reasonable range of 1.5% to 1.75% in accordance with Wall Street analyst forecasts. At this stage, Federal Reserve Chair Jerome Powell indicates that the central bank may pause interest rate adjustments until early 2020 or even mid-2020. With some subtlety, Powell removes a key clause in previous FOMC monetary policy statements since June 2019 that the Federal Reserve seeks to make dovish interest rate reductions to help sustain the current economic expansion. Hawkish regional presidents Esther George of Kansas City and Eric Rosengren of Boston again vote against the third interest rate cut. The FOMC continues to monitor the monetary policy implications of both new U.S. economic data and global trade risk retrenchment as FOMC members assess the appropriate path of the target range for the federal funds rate. The current U.S. monetary policy stance remains appropriate in the foreseeable future. Several economists warn that the recent dovish trifecta of interest rate cuts means fewer monetary policy levers for the Federal Reserve when the U.S. economy inadvertently enters the next recession. Many billionaires choose to live below their means with frugal habits and lifestyles. Those people who consistently commit to saving more, spending less, and sticking to a reasonable budget are more likely to become millionaires and even billionaires. Many millionaires emphasize the freedom that comes with spending below their means. For instance, the great American money manager Warren Buffett indicates no desire for having multiple houses, multiple cars, or any other kinds of material items. Buffett still lives in his modest Omaha house, which he bought for $31,500 back in 1958 and should be now worth about $276,700 after proper inflation adjustments. Instead of using a high-tech smartphone, Buffett continues to use a flip phone, although he invests substantially in Apple equity stakes. Also, the self-made billionaire Richard Branson spends little on clothes, fair watercolors, and luxury items. With modest middle-class family roots, Branson indicates that it would embarrass him to enjoy a lavish lifestyle. Moreover, Facebook co-founder and chief Mark Zuckerberg drives a modest set of wheels. His daily uniform comprises a simple t-shirt, a hoodie, and a pair of jeans. Many millionaires and billionaires enjoy more quality time with their family and friends than lavish lifestyle changes. Goop founder and CEO Gwyneth Paltrow serves as a great inspiration for female entrepreneurs. Paltrow designs Goop as an online newsletter, and this newsletter has grown into a new enterprise that employs more than 250 people over the past 11 years. Along the way, Paltrow learns many valuable lessons from one profession to another. As a former movie star and country music performer, Paltrow needs to ask good questions during her lean entrepreneurship. Paltrow offers this piece of personal advice in a recent episode of Talks at Goldman Sachs. At the same time, Paltrow admits that it can be difficult to be vulnerable around ignorance. It is not easy for Paltrow to start from the entertainment industry, where she achieved a lot and knew much inside and out. Now she tries to build an e-commerce company by asking lots of good questions for better clarity. This critical experience allows Paltrow to help other female entrepreneurs navigate the startup terrain. By sharing her life lessons and money mistakes, Paltrow helps ensure that many other women avoid making the same mistakes through their startup years. It is important to empower female entrepreneurs because women can accomplish a great deal that men cannot.